All right. I am so happy we're all able to get together this afternoon on a very hot topic that people are just hearing buzzwords about, but really need to understand the tax implications in the real estate industry, especially if you're investing, which is why I'm so happy to be co-presenting with Tony Watson. He is a leading expert in the field. I work with him regularly. I've referred several clients to him that are very happy. So I'm glad we have an expert that knows this inside and out. So we're going to be going over the CARES Acts and how to reduce your liability. A little bit about Marshall Reddick Real Estate if you're a first time person joining us, but I know I see a lot of people on here right now that are familiar to me. So bear with me if you already know what we do and who we are and how we've helped you. But to everybody else that doesn't know, we've been in business for over 30 years and we specialize in helping people buy and sell real estate. In all that, though, there are many moving parts. So, as you can read, we have everyone from a real estate broker to contractors to repair properties, most importantly, a property management team to babysit that investment, CPAs, um, like Robert Hall and Associates, insurance agents, accommodators, and so much more. Really excited to share our entire power team with you at a later time when we cross that road. This is me. I'm Tanya Lorimore, second generation to the company. I'm a licensed broker for over 8 years in California. I love what I do. I eat, sleep, breathe real estate. I'm over 600 transactions now, and it just continues to grow every month. But I'm a finance major, so I love numbers. Love to sit down and crunch them with you and really show you how the investments work to your benefit in the long run, short term, whatever your plan may be. I am a licensed real estate broker, as you can see, since 2012, 7 years with Marshall Reddick now. I love what I do, so let's keep it going. A little bit about what I do as an advisor. I help people with their goal setting, and then I evaluate options when they can purchase, how they can get there, right? Those are all part of the consultation and learning how quickly we can act and on the smartest plans for you and your time frame. Everyone's different. What kind of home neighborhood do you want to buy in? Where do you want to buy? And then introducing you to the power team for that area. So that's what you can expect in working with us. A lot of our clients are repeat purchasers, and a lot of my clients today are referrals from my regulars. So, how do we even choose where to invest, right? When you go on our website, you'll see the multiple markets that we're in. We don't focus on areas where you had fun during the summer at grandma's cottage, right? That was a great place to vacation, but we need to make intelligent decisions on where to invest your money. And that means all these have to be a part of that. A strong job market, vacancy rates low, right? That means days on market not making you money. We want to fill it as fast as possible, which is heavily influenced by the economic diversity, right? So there needs to be a lot of different job opportunities, housing affordability, buying a penthouse in New York or a estate on Malibu Beach doesn't quite fit that model. Housing affordability versus the rent rates. Is it landlord friendly? The states that we're in are landlord friendly. A lot of college universities, but the most important part is a reliable property management company to take care of your investment. So, all that being said, we're here to discuss the CARES Act, and glad to have shared a little bit about who we are and what we do in the long term. But I want to answer all your questions. I'm a teacher of real estate, so all your questions are important. I highly encourage you to, off to the right, you'll see a questions interaction chat area. During this presentation, Tony's going to share a lot, and I want you to not have your questions forgotten by another topic later on. Please enter your questions in. It will be saved by your name, and at the end, I'll be able to address them at the end of the webinar and go over them. Okay, guys? So without further ado, I'd really like to bring Tony on. Tony, are you there?
I am here. Thank you so much for having me today.
Awesome.
Thanks again, guys. Tanya and I have known each other for quite some time. I really appreciate all of you joining us today. There's a lot of great information that Tanya and her team at Marshall Reddick have ready and available for you, and they've been assisting our clients with real estate needs for, gosh, I mean, probably close to a decade now, I think. And we love working with Marshall Reddick, and even though they're on the south side of Southern California, we're a little bit north from them. I think that with our two teams, when we combine our powers, we can really cover a majority of Southern California. And obviously, I think we have clients all over the U.S. Actually, I was just talking to my boss the other day, and I believe that we're actually servicing tax filings in all 50 states these days. So just once again, my name's Tony Watson. I appreciate everybody tuning in today. There's been a lot of confusion, a lot of misinformation, a lot of questions that have gone unanswered about the CARES Act and what's been going on over the past couple months. And this is all coming out of a 2-year period where we were filing under a new tax bill as well. So, you know, kind of compounding all of this on top of each other, I can only imagine how confusing all of this is for the general public. So for John Q. Public, I like to say. So today, hopefully, we can squash some misconceptions, talk a little bit about what plans are out there and available, and most important, to get you in contact with the right professionals. Obviously, for any of your real estate needs, you're going to reach out to Tanya. For any of your tax needs, any questions about the CARES Act, or any questions about the EIDL loans or the PPP loans or mortgage forbearance, which we're going to talk about a little bit today. If you have questions about all of that, feel free to reach out to Robert Hall & Associates. Our staff is here and willing and able to help as much as we can. We've been trying to help as many people as we can, but obviously here in the state of California, there's a lot of clients who are very much in need of assistance, and we're being as available as we possibly can, even if it might mean from our couches at home, right? So today we're going to talk about the CARES Act and obviously how to further reduce liability moving forward under this new tax bill. Just a brief background of who we are and what we do, and just to make sure that you know it's not just me, a single person sitting in a garage preparing taxes somewhere. Bob Hall's been around since the early 70s. I myself have been with Bob Hall for, I think, going on 15 years now. So I've worked with him and our staff for quite some time. What I thought was a trying time in 2008, 9, and 10, that has been overcome by what we've been seeing over the past couple months. This has been a very scary time, and I think that it's probably more scary for me because it happened so quickly. You know, whereas the last recession that we saw, it was more drawn out. We had definitely some time to plan for certain things, whereas this one was very much a damage control type situation. So, but like I said, we've been around for a very long time, servicing a lot of clients all across the U.S., a majority of our clients being here in the Southern California area. Just to kind of jump into the bare bones of the CARES Act and the COVID-19 changes with the Internal Revenue Code and the federal government's releases over the past couple months, I did want to talk very quickly about the mortgage forbearance and squash some misconceptions about what people have been hearing. Mortgage forbearance, if you haven't, or if you don't know what that is, or if you haven't heard of what's been going on, obviously the banks do not want you to be forced out of your home. So the banks have been working with their clients to delay mortgage payments if for some reason, because of loss of job or because of delay in employment, the banks have been working with their clients to suspend mortgage payments out to 180 days. And then if you needed further than that, then you can request another 180-day extension. But what a lot of people don't understand is that mortgage forbearance does not mean that you are not having to pay your mortgage or that the bank is going to cover your mortgage payment for you. This is just delaying the, not inevitable, but it's delaying the payment of your mortgage payment. And all of this time that passes, your interest is still accruing. And so I think the reason why we really want to hammer this home is to make sure that if you are still working, and you are bringing in revenue, do not stop making your mortgage payments. Continue to make your mortgage payments if you can. However, if you are not able to make your mortgage payment, the first people you should contact are not Tanya about this, unless Tanya wants to be contacted about the mortgage forbearance stuff, but the first place that you should go is the bank, to make sure that the bank is on board with allowing the delay of your mortgage payment. The one thing that you don't want to happen is just for you to stop making your mortgage payment and not be in contact with your bank or financial institution. I was telling a client the other day that, US Bank, who is my mortgage servicer, they reached out to me the other day just to see how I was doing, to check on me and to make sure that, my employment was still, still going on, and that I wasn't being impacted terribly by the COVID-19 outbreak. And I thought that was a great service that they were offering. I thought, wow, you're reaching out to all of your clients, and I'm very fortunate to have a job that, through this whole COVID-19 outbreak, we had tax season, obviously, and so I worked right through it. But I thought that was great that the banks are starting to reach out and make sure that people are in a good position, and if they aren't, how can they assist with that? So the first point of contact, if you are not able to make a mortgage payment, whether it be a primary residence or a rental property, you should contact your financial institution and just make sure that they're aware that, hey, I might be a little late on my mortgage payment, or I do need to request this 180-day delay. So just be aware of that. Now, once again, the interest is still accruing on this. And some of the questions that we're getting about the mortgage forbearance option is, will the client or will the property owner owe the entire unpaid amount as a lump sum once the paused period has ended at the end of the loan term, or how is that going to happen? I mean, do we end up owing 180 days of mortgage payment and interest all at once, or how is that going to be spread out? And so what we've been told is not really an answer by the federal government, but it's to contact your bank, because each bank is handling this in a different way. Obviously, there's some checks and balances that the financial institutions need to go through to make sure that if you can afford the mortgage payment, that you are continuing to make the mortgage payments. And if you truly cannot afford to continue making the mortgage payment, that you do have the ability to delay it, and that lump sum payment that you fear at the 180-day period, once that's over, that you're not going to have to pay it all at once. And so the banks are really working with their clients to make sure that they're not putting them in even a deeper financial situation where they feel like this is just a snowball effect, essentially. There's a couple other questions that we've been asked. Can loan terms be extended so missed payments are added to the end of the mortgage? Once again, this is something that you want to talk to your lender about, because normally the way that you can extend the term of the loan is by doing a refinance. And so what I think probably will be happening, and I have a lot of clients refinancing their loans right now, is that there may be an easier or more streamlined way of going about a refinance, or the bank might just do, I don't want to call it a loan modification, but in the simplest terms, they might be able to modify the loan to make up for this 180-day paused amount for making these mortgage payments. So you definitely want to reach out to your financial institution and ask them these questions. Some of the smaller banks have been able to maneuver around some of these changes a little bit easier because they have less government interaction, less government regulation to follow. Some of the larger banks have been able to move quickly, but there's a lot more hoops that they have to jump through in order to get things done. So the last thing that you want to do is delay and procrastinate. If you feel like you're going to run into a roadblock in a month or so because of money, money being tight nowadays because of not being able to go back to work, or that you've been laid off or let go, these are very common things that are happening. Don't be afraid to have these conversations with people, especially the people who have debt on your home that you're paying the mortgage to. So another question, for instance, that we've been asked, will subsequent monthly payments be higher for a period of time to make up deferred amounts. Like, will at the end of the 180 days, will my mortgage payments double each month to make up for this? And once again, that might be the case. That might be an option. But a lot of these financial institutions, they've been really good about kind of mapping out some game plans for their clients to make sure that they don't lose their homes. I knew this a long time ago when I first bought my very first rental property. I know that banks don't want to own property. They don't want assets sitting on their books. They want to collect the interest on the debt that they've loaned you. So they do not want you to foreclose or short sell your home. They want you to stay in your home. And so a lot of these financial institutions, they're doing whatever they can to make sure that you stay right where you are. And so just be communicative with them, be in touch with them. Don't ignore their phone calls, and make sure that whatever plans they have available for you that you're applying for. Okay, so that's about mortgage forbearance. Accelerated depreciation, something that I'm actually pretty darn excited about, especially for my rental property clients, is that the federal government, part of the CARES Act, they took the 27.5-year depreciation lifespan for improvements to rental properties, and they essentially almost cut it in half. They dropped it to 15 years. And so for those of you who made major improvements in 2019 to rental properties, let's say you gutted a kitchen and you added, $30,000, $40,000, $50,000 in improvements to one of your rental properties, instead of depreciating that expense over 27.5 years, you can now go back and change or amend that tax return to drop it from 27.5 years to 15 years, which gives you a much larger depreciation write-off. Now, some of you in the audience might, if you're a veteran tax filer and you've been in the game for a really long time, you're thinking, well, that just means that on the tail end of this, that I'll have more depreciation to recapture if I ever sell my property. That is very true. The more depreciation you take on your rental property during time of ownership, when you or if you ever sell that home and not through a 1031 exchange, you would have to reach back and recapture all of that depreciation, add it back as income, and pay tax on it. So some of you might be shaking your head and saying, oh, well, the federal government's just going to make more money off of me this way. And yes, that unfortunately is the case, but that's if you don't 1031 exchange the property. And for some people who do have or need the deduction for this year, accelerating the depreciation from 27.5 to 15 years could free up a lot of cash for a lot of property owners. So if you want to dive into more detail about how this may impact you, I'm not saying that you should go out and amend a return to change this, but if you do, you definitely want to map out a game plan with your tax advisor first to make sure that it makes sense financially. Why would you jump through all those hoops, pay to have an amended return filed, if it's only going to save you, a couple $100 in tax? So it's got to make sense financially to do this. And moving forward, any improvements that you make to the property, you'll just go ahead and put them at 15-year depreciation lifespans rather than 27.5 years. So it'll be much easier to file in 2020 than it would be to go back and correct 2019's income tax returns. So one thing that kind of to piggyback on the accelerated depreciation for also the veteran rental property owners and even the newbies in the webinar today, one thing that the federal government did bring back is something called a carryback loss deduction, meaning that if over the next year, now maybe not in 2019, because remember before the COVID-19 outbreak, the economy was doing, it was gangbusters. Everybody was making money. If you had the ability to invest in real estate, if you had the ability to put some money into the market, 2019 was a great year financially for everybody. And then 2020 rolled around, and because of this, unforeseen event, everybody has been impacted by this. It's been absolutely insane. We've seen what the market's done over the past month or so, and we're back to 2009, 2010, and now they're talking about even being on the brink of another Great Depression. So I'm not talking about negative things here. We just need to figure out a way to secure our financial stability, how to put some support under us to make sure that at the end of the day we have something left over if we are truly being impacted by this horrific pandemic. So one thing that they did come back with is this carryback loss deduction, meaning that in 2019 or if in 2020, if you show losses through your real estate portfolio, and let's say that it's enough of a loss to kick your overall income into having an NOL, a net operating loss, you can go back and amend 2019, 2018, 2017 returns and carry back the 2020 loss to offset income you paid tax on in previous years. It's called a carryback loss deduction, and this is something that actually was gone under the 2018 tax reform bill, but they brought it back just to make sure that, hey, instead of having to worry about whether or not you're getting money back this year, if you paid tax in 19, 18, or 17, and in 2020 you're going to show these big losses, let's go ahead and give the taxpayer the ability to carry back this loss and get some money back that they paid in previous years. So very, very complicated part of the Internal Revenue Code, but if you are interested in learning more about how to make that election, feel free to reach out to Robert Hall & Associates, and I'll give you our contact information at the tail end here. Another major topic is the EIDL loan, the economic disaster loans that the support plans that are being released, as well as the PPP plan, which once again I didn't include that today because it is very much a specific type of loan plan that maybe a lot of people in today's webinar aren't really going to be impacted by. But once again, if you have questions about it, feel free to reach out to our firm. We can get you those answers to those questions. One thing, just like I stated about the mortgage forbearance, the first contact for EIDL and the PPP loan plans would be your financial institution. I had a lot of clients reach out to me directly over the past couple months, and I had to redirect them to their bank first to see exactly what their bank, their financial institution, needed from their tax returns in order to apply for these loans. Remember that the EIDL and the PPP, it's not a tax return, it's a loan application. And so the first people that you want to go to for a loan application are lenders. And your financial institutions, most of them have been very helpful. Obviously, there's a certain level of patience you need to have with them because, as you can imagine, there are hundreds and hundreds of thousands, if not millions, of people applying for these loans on a weekly basis. And so the banks are heavily burdened by the application process. They did not have an infrastructure in place for all of this. They are slowly catching up with all of this. And once the first round of financing was out, meaning that there was no more money, the federal government put into play a second round of financing where certain loans that weren't being funded are now actually going to be receiving funding. So the EIDL can be up to a $10,000 loan amount. It is forgivable debt, so meaning that if you actually do qualify for the debt, and you needed it because of your business or your rental properties being impacted by this COVID-19 disaster, that the overall debt is forgivable by the federal government, meaning that you do not have to pay tax on it. But the application process is very specific. They're going to ask for certain amounts of income in certain instances, like with the PPP plan. They're going to want to know your monthly income. They have a multiplier by 2.5% to show you essentially what type of loan amount or what level of loan you'll qualify for. So before you start navigating the SBA website by yourself and trying to apply for the loan on your own, you definitely want to reach out to your financial institution and see if they have any assistance in filling out this application. A majority of the information is personal information, but there is a portion of the loan application, obviously, that requires tax return information, and that's where we've been able to assist. And what I've been telling clients is that through this whole process, through the loan application process, through the process talking to your lenders, the process of even managing your own business, you need to remember to have patience with everything, because right now everybody is on pins and needles. Everybody's worried about the future of our economy, the future of our country, the future of your own individual businesses. And there are a lot of people homeschooling their kids right now, and they're stressed out. Just have patience and understand that everyone who you surround yourself with business-wise, they are there to help you, and they're trying to help a lot of people at the same time. And so they are there. Just be patient with getting the money, looking out for your stimulus checks in the mail. A lot of this takes time. Unfortunately, if we all had the ability to snap our fingers and just to get the money in our bank account, yes, we would all do that. But a lot of this does take time, and patience is virtue. Just make sure that you're not letting it add to the stress that we've already all been blessed with, so to speak. But it's all about how we take this situation that we're facing and we turn it around and we capitalize on it, because I can tell you right now that coming out of this, we will all be smarter. We will all know a little bit more about our financial institution, the banking system, our tax returns. We will all be better because of how we approach this situation. It's all a matter of how we approach it, though. So just keep that in mind, okay? And dating back to 2018 really quick, obviously after the COVID-19 changes, the CARES Act passed. Remember that after all of that happened, we still are filing under a new tax bill on top of all of this. 2020's tax code is very similar to 2019. But now in 2020, so 2021, when we file for 2020, there's actually going to be boxes on your return that show that you've applied for certain relief plans from the federal government. There will be new forms that we file with your tax return. There will be changes to accounting methods. There will be accelerated depreciation write-offs. There will be lifting of limitations on certain losses that we're able to take. So how does the 2020 tax code, how is it going to impact your taxable real estate income? Well, first off, we're still going to be allowed that 20% QBI deduction, where the first 20% of your QBI, your qualified business income, is tax-free. Well, let's talk about that really quick. Let's talk about what QBI is, because qualified business income is actually pretty easy to understand if we can break it down into two buckets. QBI really only includes self-employed income and rental income. QBI does not include W-2 income. It doesn't include interest income. It doesn't include capital gain income. Qualified business income is really, just to kind of break it down into the easiest, position to understand, it's your rental income and your self-employed income. And I don't know why there's a question mark there, but yes, rental income is one of those. And obviously, in order to qualify for the QBI deduction, the qualified business income deduction, you have to have qualified business income. So if those of you in today's webinar have self-employed real estate income, if you have rental income, so we're talking about contract 1099 income or rental property income, then boom, you may actually qualify for 20% of your QBI to be tax-free. But once again, I use that word qualify, right? So like everything under the old and current Internal Revenue Code, we have to make sure that you're qualifying for this benefit. So let's break it down. The first thing that we need to look at in order to figure out whether or not we qualify for this benefit is, what is your filing status? Is it married filing joint? Is it married filing separate? Is it single? Is it head of household? Well, I think the easiest way to understand this is, are you married filing joint? And if you're separate, single, or head of household, then you're obviously not filing joint. So this flow chart is going to break it down into probably the easiest way to understand it, I believe. So if you're married filing joint, you're going to go to the left. If you're single head of household or married filing separate, you're going to go to the right. So the first income qualifying threshold would be $321,400, and we're talking about your taxable income. So if you're married filing joint and your taxable income is at or below $321,400, boom, you qualify for the QBI deduction. If you are single, head of household, or married filing separate, and your taxable income is below $160,700, then boom, you qualify for the benefit. But if it is above those thresholds, then obviously there's a little bit of an adjustment, because you're not in the full qualification threshold for the QBI deduction. And I'll break that down into what QBI deduction and why this all makes sense in a slide or two here. But if your taxable income, married filing joint, is over $421,400, then you do not qualify for the QBI deduction of 20%. Same with if you're single, head of household, or married filing separate, $210,700 on the right there. And so obviously there are some qualifying thresholds. The federal government loves to play this game. They say, if you make X amount or below, or if you make X amount or above, you do or you don't qualify for this benefit. Obviously, this benefit is meant for individuals, single individuals, or married filing joint couples who make at or below this income threshold. Now, I did want to point out that we're talking about taxable income here. We're not talking about your gross income. We're not talking about the number that shows up on your W-2. We're talking about your taxable income, which is after you've deducted all of your expenses, your mortgage interest, your property taxes, your charitable contributions. If you're self-employed, we're talking about deducting your business expenses, your travel, cell phone, online charges, meals, equipment purchases. If you're in real estate and you have real estate rental properties, all of your mortgages and your improvements. And so after all of that is deducted, that's what gives you your taxable income roughly. And so these numbers are essentially net figures. And if you are a specified service or trade business, then unfortunately, you probably don't qualify for the QBI deduction. If you're a doctor or if you're an engineer or a specific specified service or trade business, there's a whole list online that you can pull up. You may not qualify for that QBI deduction. But there are very specific requirements that need to be met in order to qualify for this benefit. And essentially why you would want to know this is because at the end of the day, if you do qualify for the QBI benefit, this 20% deduction, and let's say that you are self-employed and your business made $200,000 in profit last year, right? If you qualify for the QBI deduction, essentially the way that this works is it makes 20% of your company's $200,000 of profit tax-free. What's 20% of $200,000, right? That's $40,000 of your income you pay zero federal income tax on. So if you're thinking, well, I don't think this is really important, 20% of this number doesn't seem like that big of a deal. 20% of your taxable income, if it's $300,000 in qualified business income, right? And let's say that all of your income was QBI, that's 20% of 300,000, that's $60,000 of income you pay no federal income tax on. So keep that in mind. These are major benefits that are built into the Internal Revenue Code at the moment that you could be taking advantage of. So just keep this in your back pocket. It's like when you're playing poker. You always want to keep that ace in your back pocket to make sure that that you have the upper hand, right? Well, that is cheating, but knowing the tax code very well is somewhat like cheating. I have to be real honest with you. It's all about avoiding tax, not evading tax, right? Because tax evasion is illegal, but proper tax avoidance is not. And by knowing just a little bit of information, it can make you pretty dangerous, and you will properly avoid paying tax and not evade. Let's talk about the mortgage interest deduction. I literally ran into this situation this morning. A client of mine sent over their mortgage interest deduction, had a $1.1 million first position loan on their property that they bought February 1st of 2018. And they had thought, oh, well, I slipped in before the new tax bill changes had occurred. Well, unfortunately, the new tax bill in 2018, it did change the mortgage interest deduction amount that we're all allowed on our individual returns. Under the old tax bill, so not the new one, not the Trump tax plan, but under the old tax bill, we were allowed the mortgage interest on the first $1 million of acquisition debt on our primary residence. We're not talking about rental properties here. Rental properties, you're allowed the full mortgage interest deduction because rental properties are businesses. But on your primary residence, when you buy a home, if you bought the home before and you actually had the loan funded before December 15th of 2017, you were allowed, or you are allowed, the mortgage interest on the first $1 million of acquisition debt. That's before December 15th of 2017. If you closed on the home and the loan funded after December 15th of 2017, you are subject to the new rule, which only allows mortgage interest deduction on the first $750,000 of acquisition debt. A lot of clients in the actual in-person seminars that I was giving before the whole outbreak happened, a lot of clients had said, oh man, I thought that mortgage interest was no longer a tax write-off. Some people even thought that property taxes were no longer a tax write-off. And that is so far from true. Mortgage interest is still a great tax write-off. It may be limited for certain individuals, but is still a great tax write-off. So I did want to make sure that everybody left with this note, is that there are two forms of mortgage interest. There's your rental property mortgage interest, and there's your primary residence mortgage interest. Primary residence mortgage interest, still a great tax write-off, but the primary residence is is still a great write-off, but it's limited. On a rental property, there is no limit. That's the craziest thing. A lot of people thought, oh, well, I thought I could only deduct interest on the first $750, and that is not the case. My client that sent over that $1.1 million first position loan amount, I looked at the loan statement, and it says on the 1098, the loan origination date was 2/1 of 2018. So I asked the client, I said, hey, I forget, when did you buy this property? And they said, oh, well, we closed in February, so we just made it in time. And I said, well, unfortunately, even though you entered into the contract, or not even a contract, but you found the home maybe before December 15th of 2017, but the loan didn't fund and you didn't actually close on that property until February of the following year. So unfortunately, they were only allowed the interest deduction on the first $750,000. So there are some very, very specific changes to the mortgage interest deduction, but nonetheless, it is still one of the largest write-offs that you'll be taking on your individual and rental property returns. Let's talk really quick about the SALT deduction. Beautiful downtown LA in the background there. And obviously the streets look pretty barren there. Nobody's out. So hopefully people will be back on the streets pretty soon. SALT deduction, state and local tax deduction. This includes anything that you paid in property taxes, in personal income tax to the state of California, any local or county tax, so LA city tax, DMV fees. You have a boat tax that you pay on. If you have any state and local tax deductions, this is one of the major changes as of 2018, where it is capped at $10,000. Now, once again, if you pay property taxes on a rental property, there is no limit because it's a business. But if you pay property taxes on your primary residence, and let's say that your property was bought for $1 million, your property taxes obviously are going to be at or around $10,000. And then when you add your state income tax that you paid on top of that, you're well above the $10,000 threshold. So just understand that a lot of people are seeing a limit on their state and local tax deduction this year at $10,000, but it might not have impacted you in the way that you assumed it would, just because under the old tax bill, there was already a significant limit in place that actually didn't allow you, this is under the old tax bill, that didn't allow you to fully deduct your state and local income tax. That's a lot of people didn't understand about the old tax bill. There was something called alternative minimum tax built into the old tax bill that kept individuals who were making over, I think AMT threshold was pretty low at about $130,000. It kept individuals making over $130,000. It kept them from deducting the full property tax and state income tax deduction. So even though it's capped at $10,000, it's not that much of a difference from what we were seeing under the old tax bill. So just be aware of that. It might not have impacted you as much as you assumed it would. But if it's on a rental property, there is no limit, because a rental property is a business. Just like the mortgage interest deduction that we talked about, right? Mortgage interest on a rental property, no limit. Property taxes, state tax on, or property taxes on a rental property, no limit, okay? So just be aware of those things and make sure that you're not limiting those deductions to $10,000, okay? Now, obviously, what else should you be doing aside from surrounding yourself with a good team, surrounding yourself with knowledgeable professionals like Tanya and her team with Marshall Reddick? There's a lot of things that you could be doing. Obviously, staying home and staying safe. That's the one thing you should definitely be doing. But just understand that coming out of this pandemic, there will be a lot of opportunity for people to get back on their feet. Right now, it's about figuring out as many relief plans for you and your business as possible, making sure that if you can't afford to pay off debt, that you are contacting your debt servicer, that you are contacting your financial institutions, figuring out a way to keep more cash liquid in your bank account to weather this storm. And like I said, and on top of that, on top of talking with your financial advisors and your financial institutions and your bankers and your lenders, you definitely want to be talking to your real estate professionals. You want to be talking to your tax professionals about setting yourself up for 2020 in the most financially beneficial stance as possible. Just because, like I said, coming out of working through the last recession, I saw more millionaires made in the course of a 3-4 year period. And I actually asked Bob about this since he's been in business since '71. I saw more millionaires made in that 4-year period than out of the 15 years that I've even worked in the tax industry. I thought it was pretty ridiculous how much opportunity came about for people who positioned themselves correctly. And it wasn't because they had money to do it. It was because they educated themselves. They surrounded themselves with the right professionals. They kept their ear to the ground for potential investment opportunities. And most of all, they didn't let fear steer the boat. One thing that you need to be aware of is that everybody is fearful of things these days, and fear can be overridden by knowledge. As long as you educate yourself and make sure that the information that you're getting is accurate, that is thorough, and that you have the right professionals in place to get you answers to questions that you may have, I think that fear will slowly start to dissipate. And I think that that is really the only way that you're going to be able to navigate your boat through these rough waters. And like I said, Robert Hall and Associates, we are here for you with any questions that you have, as much information as we can provide you as possible. There are certain things that we just can't help with bankruptcy, for instance. We're going to see a lot of Chapter 11. I think it's called not reconfiguring, but it's basically reconsolidating debts and things through Chapter 11. We're going to see a lot of that. We're going to have some webinars coming up on those topics as well. But it's about educating people and making sure that they have the right information and knowledge at their fingertips, and so that they're ready to make moves when the opportunities arise. Like I said I think I said early in the presentation, we do offer free consultations, complimentary consultations at Robert Hall & Associates. Normally, if it's an in-person seminar, we have people fill this out, but obviously we're in a webinar. So if you have questions, concerns, if you want to sign up for the free consultation, and let's say that you forget this or you drop your phone and you don't have this anymore, you can reach out to Tanya, you can reach out to Marshall Reddick. They have all of our contact information. But if you want to take a screenshot of this, if you want to jot it down, to submit yourself for the free 30-minute in-person, or not in-person at the moment, but over the phone consultation, text RHA to 38470. That'll automatically get you set up on our calendar with one of our tax professionals to get these answers for you. And like I said, if you're going through the process of applying for the PPP plan or the EIDL loan, we can assist with information. We are not currently filling out the applications for clients, though, because once again, we're not lenders, we're not financial institutions. We can assist with information, but the best source for information is your financial institution. So make sure that, once again, you're surrounding yourself with the right professionals and working with people who are there and available to help. I wanted to thank you all again for being a part of today's webinar. Stay safe, stay healthy, stay home, and I look forward to working with all of you in the future and look forward to hearing from you. Have a great day.
All right. Thank you so much, Tony. What did I say, guys? He has an abundance of information and knowledge that is being applied daily. I see the questions just flooding in. So great job on putting all your questions in so that we can answer some. But the question is, what's next, right? So again, the team who you work with represents your end result. So the power team here, from the advisor, lender, realtor, building inspector, insurance agent, property manager, and obviously the tax advisors, CPAs like Tony that can be so resourceful to save you money after you make money, right? Or figure out ways to help best protect your money. We have all that at hand for you. So here's our website. A lot of you came on and came under the events, but we have hundreds of recorded presentations from the past on different markets, different topics. Anything that you could think of, please utilize our education tab and enjoy under marshallreddick.com and the learn tab. Check out our reviews online. Look at our team. Here I am. And then, of course, we have several other agents across the United States that are on our team. But learn a little bit more about us, because we want to learn about you. Continue to be a happy client. I would love to work with you. So let's keep this collage growing and scheduling a consultation. My cell phone number is right there for you. You can call my office number. Either one has the textable format. I'm happy to answer any of your questions. Email is great too. Now, we have so many questions, so I'd really like to have a few of those answered. Tony, if you'll bear with me for a couple here. I just
Sure.
want to make sure that we get a handful answered here. So I see Lisa M. Her question was regarding the EIDL. If I receive my loan money, what do I, or what can I use it for?
Yeah, so the EIDL loan is meant to pay for fixed debts such as payroll, accounts payable, any other bills that can't be paid because of the disaster's impact. If you if and so once again, there's a lot of the loan there, a portion of the loan may be forgivable if you aren't using the loan for those amounts. And to be real honest with you, once again, completely transparent, we don't know how the government's going to be auditing these loans in the future years. We don't know how we're going to, I assume that on next year's tax return, we're going to be plugging in the numbers for the debts that you're paying, credit card bills, the overhead, the operational cost, payroll, accounts payable, contract services that you're covering, mortgage payments, property taxes, insurance. I assume that there will be a screen next year on your tax return where we plug in these numbers and then we plug in the loan amount that you received. And that's what will tell the government what portion of that would be taxable. And the interest rates for these small business loans on the portion that isn't forgivable, the interest rates are pretty low. The small business loan interest rate, I think, is about 3.75%. But there are going to be some adjustments, and this is also what I'm telling clients, that things are changing by the day. This webinar that we're giving right now, a month from now, information could change, and so we're going to continue to bring you updated information as the weeks go by, and continue to update the information as long as things continue to change. But yeah, the money coming in from these loans, you got to use it for business expenses. You can't go out and buy a new Porsche. I don't know where you're gonna find a Porsche for $10,000, but and if you do, send
Let
a
me know.
referral over to me. Yeah, let me and Tanya know. Yep.
All right. Yeah. So great question. All right. I saw a lot come through about stimulus checks. So let me pick. All right. Let's go with Gary's. Um, Gary was saying, the stimulus check that I received, will it be taxable?
No, that one of the major things that the federal government made sure of is that the $1,200 stimulus checks that taxpayers were receiving if they qualified for it, and the $500 per child check that people were getting, the federal government wanted to make sure that the general public knew that that money was not going to be taxable. So any stimulus check that you get, not the loans that we're talking about. Remember, the loans are something different, but the stimulus checks that you're receiving, if your income was under certain thresholds, that money that you're receiving is not going to be taxable for 2020.
All right. And then, like I said, and like a lot of them came in about stimulus checks. So let me just piggyback on. All right. Let me see this question. If I haven't received my stimulus check, what do I do? How can I track if it was even sent?
Yeah, so the great thing about what happened is that the federal government, the IRS, actually created a portal on their website where you can track your stimulus payment. And so if you Google, I don't usually send people to Google, but if you Google track my stimulus check, the first link that pops up will be the irs.gov link for economic impact payments. If you click that link and scroll down to, I believe, like the middle of the page, it says filers, get your payment. So if you have filed a tax return already and you want to see where your check is, you click the link that says get my payment. And if you haven't filed a tax return, if you're a non-filer, non-filers even qualify for the stimulus check. So you click the non-filer and enter payment information here. So you would enter your routing and your account information for a bank, and then they would direct deposit that check to you into your bank account. Now, you don't use it says on the website, so I'm reading this right off the website, do not use this tool if you are required to file a 2018 or 2019 tax return. So for the non-filers, it's only for people who are not required to file a return. For the people who filed the return, the link is on the same page, and it just says, hey, click this and plug in your information, and it'll tell you when exactly your stimulus check is either being sent out or issued to you. So it's actually a pretty nice little tool that just became available. Gosh, I think third week of April.
Nice. Okay. All right, you guys. There are just so many questions. Um, and I just feel that with everyone's time here, it might just be best that we get back to you directly. So we will be following up. It's only, close to noon right now. So we will go ahead and get this off to you. Your questions, we're going to start doing some Q&A, and I'll start connecting you to the right people just so that we can all continue enjoying our days. But you have my contact information. You can text Robert Hall directly for that complimentary consultation specific to taxes. If you wanted to, talk about investments, I'm here to help. But, I really thank you all for coming on today. Give me a call if you guys have any more questions. Thank you.